And we are live. What's up? What's going on, everybody? Johnny back again for another $1 million coffee hour where we have $1 million conversations. And today is no different. We have a great guest, Mr. Michael Glassby from G2. He's going to be sharing with us, talking all things when it comes to tax prep, bookkeeping, and accounting for you. That's right, for real estate investors. And so we're really excited about this upcoming holiday season. For those that missed last week, definitely go back and check out the recording where I break down our 3-year vision for REI Genius and everything that we're doing and how we plan to continue to change lives moving into the future. But then also looking at those goals and setting smart goals for yourself. Not only looking at how we're pivoting and shaping the next 3 years, but I want to understand how you guys are pivoting and shaping your next 3 years with setting the proper goals and setting the vision for your life with everything that you're building for you and for your next generation and your portfolio. So we'd love to have those conversations. As always, make sure you guys connect with us inside the school community with the Financial Freedom Network, where we're having a lot of those conversations. I'm breaking down a lot of the commercial real estate data. We're diving in on things that are happening inside the economy behind the scenes, the deals that I'm seeing on the other side of the tracks, if you will, as working as an advisor, and the conversations that I'm having with sponsors that are doing, tens to 50, $70 million deals and raising hundreds of millions of dollars for real estate transactions, to make sure to give you guys that inside baseball card view of what's happening in the world. So with no further ado, I'm going to bring up on the stage my brother, Mike. Welcome, man. Long time overdue and glad to have you on here.
Yeah, what's going on, man? Happy to be here, man. Happy to be here.
So I always like to tell people, I'll let you introduce yourself. Mike and I met some years ago, fellow veteran. I got introduced to Mike as, one of the all-stars in the Charlotte area that was crushing it in real estate. And we've always kind of been connected online. And then I know we connected, did some collaborating with his military cash flow group, yep. Facebook group with pouring into veterans over the years. And, and now with everything that he's done with G2 Business Solutions and setting up his company and how he's serving real estate investors in that space. And so I always like to kick off by telling people just what's not included in your bio to share with the audience.
Yeah.
To tell us a little something about you.
Absolutely. So every time I introduce myself, I have to start it off with letting you know where I'm from, the greatest country in the world, the state of Texas. I got to say it. But no, so my background is in the military. I spent 11 years in the military, and about 8 of those I was in Special Forces, and 3rd Special Forces Group as a Green Beret. During that time, I got started in real estate, and that's really what opened my eyes to everything else. So 3 years into it, I had over 130 rental doors, which was great, but definitely grew too fast, which you didn't know what you didn't know. And we were doing things wrong. We were buying thinking it was going to save us in taxes, and it didn't, which we'll talk about in a little bit. After that, during that, I got my real estate license because that just made the most logical sense. I started a real estate team with my good friend Shelby Osborne. That team is still active today, just not in the same capacity, but we have over 120 agents spread across about 13 different states right now. Got a little bit into property management companies, all this stuff. And then I had an opportunity when I went and got my MBA, because the GI Bill covered it, got my MBA from UNC, Chapel Hill. Then I got an opportunity to be a CFO for a small private equity company. And that's when the light really popped on for me. And it was a real estate focused private equity company, but that's when my love for business, real estate, and finances kind of all came together. So after doing that for a few years, that company was acquired. And then I decided to start G2 Business Solutions, which is a full purpose, all-in-one, full-service accounting firm specifically for real estate investors. And that's where we're at today.
Man, I love it. And I think that's the cool thing with us being as veterans and entrepreneurs. Like, you showed up today as the CEO of G2 Business Solutions, but you just talked about, own over 120 doors, over a decade in support to special operations, being active in the military, being part of a brokerage with over 100 agents, and then going off getting your MBA, working for a private equity firm and for CFO. And I think it just shows the ability and the talent level that comes from the U.S. military today, and being able, because I think a lot of times us as entrepreneurs, and I can speak for myself, that it gets lonely out here, especially when you're starting or going down that venture, because you can't have those conversations with your family, a lot of your friends. You talk to some of your military buddies that still in, or they went and got a GS position.
Mm-hmm.
That a lot of times the challenges with going out, starting a business, and working in these different arenas, that they don't have a true appreciation for the sacrifice and the challenges that you manage on a daily basis as a business owner, entrepreneur. So I'm gonna say salute to you for all those accolades, brother, because it's well deserved, man.
I appreciate it, man. You hit the nail on the head. As veterans, I tell people all the time, I don't think I'm the smartest guy in the world, but one thing that we were taught in the military was just keep going until you figure it out.
Yes.
So the resume looks great now, but boy, that was a journey. Boy, that was a journey. A lot of failures, but I feel blessed. I'm happy. I'm happy with where things are going, and we're going to keep going from here.
No, most definitely, man. So like I work with a lot of like junior real estate. I won't say junior real estate investors. I'll say real estate investors that are aspiring to get to the 100 plus doors, or to
Right.
get to maybe 10 doors. Because I tell people, like, and even I never set out to say I wanted to get X amount of doors. I just was consistently showing up, marketing, and next thing you know, I got a 40 unit under contract, a 24 unit under contract, a 20, and a lot of it was just relationships. And so I tell people, don't be discouraged that you have two or three rental properties, because if you had the right strategy, 5, 6 properties can really set you up for your goal of financial freedom over 5 to 10 years if you play your cards right. So how's that journey been for you now that you're working with real estate investors? What are you kind of seeing as some of those areas that you're helping serve them right now as they're kind of starting their journey?
That you actually hit on something that's super important. So I talked about, I got to 100 and whatever doors, and very, 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 very quickly, but I went too fast. And it's because I didn't know what I didn't know. I was going by that old thought pattern of, hey, one property should cash flow you $200 a month after expenses, da, da, da. So if you need 10,000, then you need this many, right? And so if I was like, if I need $10,000 a month, I need to get this many doors. So I just sprinted. And you just hit on something that was really important. It's not really the number of the doors, it's the quality of the income from the doors. So I sold off majority of them. I only have, I think, 32 properties right now. All right. So
Okay.
I sold off a majority of it. And as I work with real estate investors now, the idea is that we start with their objective. What is their goal? I don't care if it's cash flow or equity or whatever. And then we just reevaluate their portfolio. And then we see, can we optimize it? It's just portfolio optimization or allocation, right? Same thing you're doing with the financial advisory side. And so what I mean by that, we can turn a long-term rental to a short-term rental. We can turn a short-term rental to a pad split. We can turn some to a midterm. We can go and try to get government contracts for housing. We can do all these different things to just maximize the quality of income from the portfolio. And when you change your mindset to that, you get back to being creative. You get to reduce the stress. You get to be more resourceful, because if we got government contracts, then we got some additional funding sources. If we got this, then we can do that. So that's really the game of it. And that's why I like it. That's why I like it, because real estate is literally, I say this all the time, you're only limited to your creativity in real estate. At least that's the way I feel.
Facts.
Yeah.
Facts. No, I think you're exactly right. And I think for a lot of times we see the gurus, we see the strategies of the day, but a lot of times we don't necessarily know, how do I apply it? How does this fit for my situation?
Right.
How can I leverage this strategy or to what I'm trying to build and what my overall goal is, where you're not getting burnt out? Because I know people that were working 50, 60-hour weeks that were coming saying, hey, I want to be a wholesaler. Like, man, I don't know.
Yeah, I don't know about that.
It's gonna work.
I don't know. I don't know about that one.
Yeah, so I think that having that alignment and synergy is going to give you, it's going to energize you, one, because you're operating on purpose, you know what you're building, and then two, you're going to be building and hitting those milestones along the way that are going to get you to your goal, where you're going to have that, because you're going to be able to show up consistently and have that sustainment power, where you're not giving up or where you're not being burned out early on in your journey. So that's great. So I would say, what's kind of, looking at the new investor mindset, what are you kind of seeing on the bookkeeping side? What are some of the common mistakes they're making? Because I would tell you, that was the first person I really hired in my business. and I probably hired him 2 years too late. But when I brought a bookkeeper on as a real estate investor, as a fix and flipper.
Yeah. I would say the biggest problem with bookkeeping is the fact that people don't have it. I agree with you. And I'll tell you, anytime I speak in front of somebody, I'll tell them the number one tip I have to have better control of your finances and your business is just to get bookkeeping. And I don't care who you go to. I don't care who you go to, but you need bookkeeping, not Excel spreadsheet, not Chat GPT. You need bookkeeping. Because what people don't understand is, the IRS is very particular about how you classify income and expenses. All right. So somebody might say, hey, I'm just going to go put on a new roof. All right. And they're going to say, well, now that I got this new roof, I'm just going to treat it as an expense and I'm just going to write it all off. Well, the IRS says, no, it doesn't qualify as an expense. It qualifies as a capital expense, meaning that you don't get to write it off in year one. You actually need to depreciate it now.
Okay.
Right. And now here's the thing about it. It's like, well, could you? Yeah, you could if you do it right. I could give you a special election to write it all off this year. We can do those things. But if you don't do it right, the IRS will come back and say, hey, this was done wrong. So let me reverse this. And when they reverse something like that, let's say you took off too much and you weren't supposed to, they're going to say, no, let's add that back on. So now you owe me taxes. And you know what? You underpaid taxes. So now you owe me a penalty. And you know what? Since you underpaid, you also owe me interest. And that's the stuff that gets people in trouble, right? So bookkeeping can prevent all of that. It can prevent all of that. I'm looking at Michael's question here. Are you licensed in Virginia or South Carolina? I have an account that charged me double because I did not do the deductions correctly. Yeah, see, the deductions are serious. So we can serve all states, all 50 states. All right. We have CPAs on the team, enrolled agents with the IRS on the team. So we can serve all 50 states.
Yeah, no, great question. Definitely roll in those questions that you may have. We got Mike here with G2 Business Solutions, diving into bookkeeping and accounting services for real estate investors. Mike, what's the one thing that all real estate investors, regardless of size, that they should know about their numbers?
So there's really just three things, and we'll keep it very, very simple. How much you make, how much you spend, and how much you keep. Keep, we're not talking about profit on the P&L. I'm talking how much do you keep in your bank account. Okay. And if you know those three numbers, the beautiful thing about it is we all know, if we remember when we look at formulas, if there's three variables, two are going to impact one, right? So if we want to keep more, we know what we need to affect, how much we spend and how much we keep. And that's where we can get creative. How much we make and how much we spend, right? But that's where we can get creative. If you know those three things, how much you make, how much you spend, how much you keep. That's right. Yep, Faye got it right there. If we just know those three things, guys, it's very, very powerful. But if you don't track your numbers, how will you ever know? How will you ever know?
Yep.
I'll tell you a quick story. This has happened more than a few times, but there was a client that came to me and said, hey, look, we're cranking out $6 million a year in revenue with flips. But for some reason, my bank account, it just feels like we're broke. I feel like I'm contributing more money in. Wow. So we went in, they had bookkeeping, but it was done very poorly. So we went and we looked at all the books and come to find out money was coming into the company, but money was only coming into the company because they were borrowing more money. Their flips were losing money. They were spending too much money on help and marketing and everything else. And so they were really losing money at a rapid rate, but they kept it afloat because they kept borrowing more money. For those who don't know, that's called a Ponzi scheme, right? And they weren't aware they were doing it. So they made over $6 million in revenue, but they had over $90,000 in actual losses. That's why you got to know your numbers.
No, that's a great example. And I think that's one that hits home, especially as you look as a real estate investor and starting to try to scale and go to the next level. If you don't have everything, if you don't have that infrastructure built or that foundation built on just doing one or two deals a year before you scale up, then it can get out of control really, really fast. Yeah. Kind of where we are right now, kind of pivoting a little bit, since we are at the end of the year. Kind of what questions should investors be asking now as they're going to 2026? Because a lot of it, we're almost at the end of the year that you're really limited on how you can impact 25. But really for those kind of positioning, looking into 2026, setting their goals, how should they really be positioning themselves, or what questions should they be asking themselves, or really asking their CPA as they're going into the year?
Yeah, 100%. So I actually got a couple tax tips I'll give you guys that you might be able to crank out in the next, 13 days or so to save you a couple $1,000s off of your taxable income. We'll talk about that in a little bit. Here's the biggest thing though. If you wait till February to talk to your accountant, you shot yourself in the foot. All right. Because by that time, tax season is full bore. The accountants are busy. Let's just be honest. They're busy, especially the good ones. So we recommend that you start the conversation around November with your client, with your accountants. Now, here's the real question you got to start asking. You got to ask the question of, are you going to qualify as a real estate professional for tax purposes in 2026? That's the question you need to ask. The CPA will break it all down. We can talk through it too, but you certain number of hours, you can't do something more than that. But if you qualify for real estate professional, guys, the book opens up on what we can do for tax strategy. The book opens up. That's the question I would recommend everybody start asking for 2026. And here's why, because there is a lot of stipulations that you have to meet. And if you understand what those stipulations are, well, then you can start in January to make sure that you meet them. If that makes sense, right? Instead of trying to wait till the end of the year, like, crap, can I get enough hours? No. Let's start the year off right. So that's the number one recommendation I would have as far as the question to ask.
Yeah, no, that's powerful. That is powerful. That was one that I asked and learned. I won't say I asked. I learned about years ago. I think it was probably about 2016. And I determined and figured out that my wife, since she was a stay-at-home mom, and she was helping in the fix and flip business while I was locked away in the skiff with no cell phone and really couldn't work. She was running and executing the day-to-day for the business, and she was able to qualify as a real estate professional, which then allowed us to bring in those losses, especially with the bonus depreciation from like the apartments, and bring that in where it offset my W-2 active duty income. And it's like you said, it's a truly beautiful thing when you look at the tax law, how it's set up, and as a real estate investor, how you can benefit from
it. The beautiful thing about this is, because you're right. And so Shade, you're asking, I'm gonna share it with you here in just a second. Here's the thing though, what you just laid out, if you don't qualify for real estate professional status, I can still make you qualify for cost segregation. It's called a short-term rental loophole, right? But I need to know early on which one are you going to qualify for? Because now, if you don't qualify for real estate professional, we can go short-term rental loophole, but we got to make sure you got enough to buy the property. We got to make sure that we got enough that you're actively managing it. We got enough material participation there. So there's a couple of things that we have to be mindful of. So if you don't mind, I'm going to throw in the chat a free. You guys can go and download this just directly from my website, guys. It's a real estate professional time tracking spreadsheet. It has instructions on there. It has the full layout of what you need to qualify for, and allows you to just go in there and track your time in there. Okay. So when you do this, you have to prove to the IRS that you qualify. So having a time tracker like this as your backup, as a receipt, you're good to go. But what do you need to know, or what do you need to have in order to qualify? So we have to prove that you had over 750 hours of material participation on your properties. Now, if you download this tracker, it has a whole list of qualified activities that count for it. Okay. Over 750 hours. The next thing is, you can't have done anything more than the rental material participation throughout the year. So what do I mean by that? Let's say you have exactly 750 hours managing your properties and doing everything here, but you have 1,600 hours working at a W-2. You don't qualify. All right. So part-time workers might have a better chance of qualifying. But just like Johnny, like you were saying, you had your wife at the house. She wasn't really working a W-2. She was really managing the portfolio. Great. That works. Or if you're a full-time real estate agent, real estate flipper, okay, that works. Right. And if it doesn't work, then cool. We just need to explore that short-term rental loophole.
No, great insight. Speaking of agents, do you see, and you really you can really are in a great position to answer this because you actually work with agents. I would say of like the 100+ agents, how many of your agents really invest in real estate? Because I see that one all the time.
It kills me. That's a great question. If I had to put a percentage on it, maybe 30% or less
Wow,
invest in real estate. Which, because
that's
I know
crazy.
you were hitting on it. Like this is the one, I say it all the time. This is the one industry where you should get high on your own supply. You know what I mean? Like you
Right,
should
right.
buy as much as you can. I mean, you have the inside scoop. It's like insider trading, but legal. You know what I mean? So yeah.
Yeah, no, that's one I always see. And I talk with agents like, well, no, I don't really invest. I'm like, why not? Why not? It's like you see deals, you're in the brokers meeting, you're seeing what's going under the deals that are in the pocket listings that are happening. And like you just got to get one project, just get one flip project or something.
Mhm.
And you may bring in 30-40% of your annual income in one project. But a lot of times people they have the narrow beams, narrow focus, and for whatever reason it doesn't work out.
And I know you see it all the time. Some people are focused on the income that they can get today and use today, and that's fine. I mean, that's your prerogative. But real estate agents have some of the highest taxations out there, especially if they're performing well, because there's hardly any real operating expenses that you can count against your income. Hardly any.
Yeah.
So it makes so much sense for you to buy real estate, accelerate the depreciation, and wipe away your taxes. But some people are like, nah, I don't really want to own property. I just want to get this cash and ball out. And that's fine. I mean, that, to each their own.
Mike, do you have the opportunity to work with a lot of the real estate investors that maybe have like the solo 401ks or the self-directed IRAs?
Yeah.
And okay, how are you kind of seeing how do they operate with some of the tax considerations with kind of leveraging those as business owners?
Yeah. So this is a good question. So this comes up all the time. So to be clear, I'm not the financial advisor. I leave that to Johnny. I leave that to whoever else, right? So when we're talking about taxation or tax strategy, it's really twofold. Are we trying to save more in taxes today, or are we trying to save more in taxes in the future? And the reason I bring this up is because with traditional retirement accounts, we can get the tax savings today. But a lot of people don't like that idea because they don't know what the tax rate is going to be in the future, or they think they're going to make more income in the future. So one thing that we have really looked at when we start looking at tax strategy, and we work with their financial advisors to make sure that it's all part of the plan, but we can take advantage of the tax deductions today. So we try to max out the traditional contributions. And then if there's a lull in income somewhere else in the future, then we just do the Roth conversion, the rollover conversion. So there's a constant conversation of what do we give, what do we take when it comes to those retirement accounts, as far as what we're going to see for the taxation side. Now, on the flip side, let's say these are self-directed. The other conversation depends on what, traditional or Roth, but they're talking about how do I invest this money into something else and grow it? Well, if depending on the structure that you're in, that's going to determine the taxation of it, right? And so after that, then it literally just comes down to evaluating it just like any other property. And so we'll play that game. We'll kind of go back and forth. We'll bring in whoever we need to, their financial advisor, whatever, to talk through it all. But that's the conversation that we're having. What do we do today versus what are we doing tomorrow?
No, I think that's really good insight and feedback because a lot of times I know, especially with like the retirees and military retirees
Yeah.
and other business owners that are looking at, hey, how do I take back control of my 401k? How do I self-direct and how do I make some of these decisions? And a lot of times it centers around the tax implications
Mm-hmm.
of what you're doing. What are some of the conversations, I guess, with some of your LP investors that are looking at maybe limited partnerships that have that K1 income?
Yeah.
Um, what are some of the conversations you're having with them this time of year?
Great point. So we have a bunch of investors trying to rush in to syndications as limited partners right before the end of the year because they're looking to try to maximize their tax deductions and things of that nature. All right. And so for most of these things, just so everybody knows, if you're going to use any type of property or real asset, tangible asset, you have to have it owned and operating before December 31st, right? It's different for contributions to retirement accounts. It's a different story. But the reason I say this, because everybody's now like, hey, is this going to work for me? Can I put my money in this thing? And the conversation really starts to we get clarity around the fact of what type of income is it going to be treated as, right? Is this considered non-active income, AKA passive, or is it considered active income? Most situations as a limited partner, it's considered passive. So what does that mean for us? Our passive income or losses cannot count against our active income. That's what it all boils down to. Here's the biggest distinction between active and non-active. Is there something that's called, we refer to it as self-employment tax, but it's your FICA, your Medicaid, and all of those other things that you're paying. It's equivalent to 15.3%. That's what it's equivalent to. If you're working a W-2, your company is paying half of that, and the other half is being withheld from your W-2. If you're an employee, if you're self-employed, you're paying all of it because you're the employer and the employee. So when we look at active income, it's subject to all of that tax, right? Non-active income is not subject to the 15.3. So the IRS is not going to say, hey, you got this big loss as a limited partner, a non-active activity. All right, great. We're going to reduce your self-employment tax. They're not going to do that, right? So that's the biggest conversation we're having is, hey, I don't mind. You can put as much as you want in these syndications. You can put $100,000, $500,000. But is it going to give you the tax savings that you're hoping for? That's the conversation that we're having right now.
No, that is awesome. And I think a lot of times these conversations, we wait to the last minute. We're in December, 2 weeks before closing out the year to understand where we should start moving money. And I think a lot of times it puts us in a position where we're chasing the tax savings. The tax savings are wagging the dog essentially. When you're not really looking at the underlying financials of the deal and making sure that it's a great deal and it has the suitability for what your goals are, but you're really just looking to place capital for the tax reasons. And and I'm having conversations now with people on the oil and gas side. We're looking at different
Yes,
opportunities
yeah.
on the active income. We're deferring that way. And a lot of times, that it's tax, tax, tax. I'm like, whoa. I'm like, let's look at this. We gotta understand, hey, how this fits into your overall financial plan, and have those conversations too. So, no, I think that definitely hits home with where everyone is, because at the end of the day, if you want to understand how you can keep more of your money and how you want to be incentivized by the federal government to do it legally, just look at the tax code, because the tax code is directing money in areas where the government wants capital to be placed, i.e., opportunity zones. When you look at all the benefits for opportunity zones, because they want investor capital to flow there, because the government does a horrible job of providing housing, and they don't want to be a housing provider across the U.S. And so the way that they get around that is they incentivize capital investors, mom and pop landlords, to provide housing uh, for investors and for residential, just everyday civilians out there. And so I think when you start looking at where we are right now with the shortage of housing, somewhere in the millions, I see it anywhere from 1 to 4 million, just depending on who you're asking. We have a shortage of inventory, especially affordable housing. We see a lot of the Class A housing that's coming on the market that's not really affordable. I watched the article in Denver right now where there was this huge 300 some odd Class A apartment complex that they just gave the keys back to the lender. And and now they were like, people can't afford to live here. They were given 2 or 3 month concessions. And it's just a bad situation because now it's just been overbuilt and there's so much capacity and people aren't there right now. So I think a lot of opportunity for the mom and pop landlords to be strategic in your local markets and really focus in on your real estate acquisition strategy, but then also understanding the tax strategy. And I would say, kind of dovetailing into that, what are some of the benefits you're seeing for your clients with the big, beautiful bill that rolled out, with the tax implications that came with that? Because I know that's one where people are really looking, hey, I can take this bill that was passed, for all the good and bad that comes with it, but how can I set up my portfolio, or I can really position myself in 26 to take advantage of it?
That's another great question. And the one thing about taxes is this is why it's so important to have a team behind you, is because it changes every year. Changes every year depending on who's in office or who's whatever. So big, beautiful bill. There's two major things for us that have really popped up. The first one is the bonus depreciation was declining. It started at 100% and it was working its way. It was phasing all the way out. It was at 40% this last year. The big, beautiful bill brought it back to 100%. So what that means for us is if we are able to take a property specifically for our real estate investors. We do a cost segregation. So we chop it up. Instead of breaking it out over 27 and a half years, we're saying the roof is 5 years. The da-da-da is 10 years. This is 7 years. And the bonus depreciation allows us to take all of our 7 to 15 year property and reduce it all in year one, in year of acquisition. So this goes back to that conversation of how much can I write off when I spend this money, which is a very important thing. And I think Michael was just mentioning that when you did not do the deductions correctly, it's probably something associated with that. So the bonus depreciation is huge because now people can go out and buy one of these properties before the year end, make sure that they qualify, whether it's short-term rental loophole or real estate professional status. And we just helped one of our guys. He bought a nice, beautiful property, and we were able to, it's a short-term rental. We're able to save him $115,000 in taxes. Save him $115,000 in taxes, not reduction of taxable income. Dollar for dollar, $115,000 in taxes.
Nice.
That's insane, right? So it's a very powerful thing because of that bonus depreciation. The second thing that we've ran into is, so there's something called a state and local tax. It's called SALT tax. When we look at our deductions on our personal returns, we have an option to either take a standardized deduction that the IRS gives us, or we can itemize deductions in hopes that our itemization is more than the standard. So this goes back to, well, hey, if I donate $1,000 this year, do I get a credit or do I get a deduction? You get a deduction, but if your standard deduction is more, then you just donated and you got no tax benefit. That's another important conversation. Well, the SALT previously, the state and local, that means if you pay state taxes, you're limited up to $10,000 that you can itemize. So if you pay more than $10,000, which a lot of people do, surprisingly, to the state, they're only limited to $10,000. And so it made no real impact. Think about the high income state taxes, the Californias, the New Yorks, the Missouris and stuff like that. So now the limit is 40,000. They just upped it to 40,000. And for those who don't really understand what that looks like, now what I want you to think about is when we get real strategic here, there's a lot of different ways that you can structure your companies. And most of them in the beginning, they're just treated as pass-through. So whatever income the company makes, we're just going to tax you at your personal level. But a lot of states allow you to do something called pass-through entity taxation, where we can tax the entity directly. All right. And so what this now means is the company can pay the taxes and we can treat it as a deduction in the company, like an actual write-off. And then we just carry over that tax payment and put it to your itemized deductions to help you increase your SALT limit, the limit, right? And so a lot of people were doing this to increase past that $10,000 limit. But now with the 40,000, we can go way above it. And so itemized deductions, we think for certain individuals are going to be a lot more favorable than the standard as we move forward. So those are the two biggest changes that we've seen. And there's a few more, but those are the two most impactful that we're dealing with.
No, thanks for sharing it. I think a lot of times, that really brings up a great point with having a knowledgeable CPA like yourself and having a trusted advisor. That's one of the things that as I got more seasoned in real estate and joined mastermind groups and just we're seeing how other millionaires were moving and just understanding on that, having an advisor, having a tax strategist, having, someone that's on the legal side of things, that they have advisors with knowledge that gives them the information where they can run, where they weren't trying to be a generalist or, and not trying to have the right people around them. And I think when you start looking at the top, any Fortune 500 company, they have a chairman of the board, they have a board of advisors, they have expertise, they have a diverse set of individuals around them that bring different talents and skills to help them be great at whatever their business is. And it's no different for you, that you have to have at least five people around you that are experts in what they do. That I say, as the Bible says, iron sharpens iron. And having where they're coming in and helping and they're driving you to success. And I think having that sound accounting and bookkeeping is no different there with being able to set yourself up for success. Because I think as a lot of times as an entrepreneur, you're so used in the mindset, I got to do it all myself, that, I'm an army of one.
Yes.
And and I'm just doing it all in here and just putting it together. It's like, no, you got to come up a little bit to the strategic level and look around. How can you bring in the right people? And I think that's one of the things too, because you guys you operate as a partial CFO as well, right?
That's right. That's
Yeah,
right.
talk a little bit about that, because I think that's something, for those business owners that may be looking to scale and go a little bit further, and maybe not in a position to hire a full-time CFO.
Yeah.
That may be a great asset for them.
Absolutely. We actually started as fractional CFO services. So I took my CFO experience and then I just said, you know what, let me partial this out or partition it out and let me help others. And so with a fractional CFO, the idea is imagine, so the average salary for a CFO in the US is over $460,000 annually. All right. Now, yes, there's some on the lower side, but a lot of them are pretty high. The CFO is typically the second in command, the 2IC to the CEO, right? So this is a pretty high position. Most people can't afford that position. So now it's imagine about having a CFO almost on retainer, right? A part-time CFO. Hey, we'll pay a flat fee. We want you to run CFO activities, but we don't need you to work 80 hours a week or even 40 hours a week. We really need you to get a good concentrated 5 or 6 hours out of the month, and then add that value back to the financial department and bring that value back to CEO. So that's what we do. And with that service, we're basically, I like to think of it, or I like to explain it as the financial quarterback, right? We're the quarterback of the financial department. So as a CFO, we're working with your accountant, we're working with your controller, we're working with your bookkeeper, and we're making sure that that team is functioning the way they're supposed to. And then we're taking all of that data and we're actually presenting it to the CEO, showing you what's valuable, right? What is actually valuable. We talk about how much you make, how much you spend, and how much you keep, which is, that's the bottom line. But being able to interpret that to determine where do I need to focus to make it better, sometimes that's a unique skill, right? Or it's a learned skill, right? It has to come over time. And so we help close that gap and give you the information that you need.
Oh, that's awesome. That is awesome. So if you're looking for a partial CFO, definitely have a conversation with Mike and his team, and they can hook you up. No, this has been great, man. I want to kind of pivot now. We missed a couple questions from YouTube. I'm gonna bring up. So we have Investor Success Mindset 627. Thanks for tapping in this morning. What's the most commonly missed tax deduction you see with real estate investors? That's a good
Perfect.
question.
Two of them. One is mileage. All right, guys, just track your mileage. There's a lot of free services, Mileage IQ, Hurdler. If you guys are already in QuickBooks, which I ask you all to go to get some bookkeeping. If you're already in QuickBooks, QuickBooks also has a free mileage tracker when you download the app to your phone. It works the same way as Mileage IQ. That's the first one. The second one is home office reimbursement. Now, it's not necessarily missed, because if a lot of real estate investors raise their hand and they say, hey, accountant, hook me up, they'll do it. But what they'll do is they'll give you the simplified version of the home office reimbursement, which caps the maximum amount is only $1,500, $1,500. I can't tell you how many times we've done the itemized version of it, and we've increased that 15 to 6,000 to 7,000 to 8,000, because we're actually tracking all of the expenses associated with the house, and then we're dividing it by the proper percentage. So those are the two most common. When I look at a tax return, I see it immediately. I say, hey, go add this, and then we can add an additional couple $1,000s to the reduction of the taxable income.
No, great question and great answer. Yeah, that's definitely one that when I was fixing flip, I didn't really track the mileage tracker
Most people don't
at all. Cool. Our second question we have from online. This one comes from Mindset Transformation U. Good morning. How do you treat QOZs, qualified opportunity zones, in bookkeeping? It's another good one.
So the bookkeeping is going to be the exact same. So that's a really good question. The bookkeeping doesn't change. What qualified opportunity zones is a tax activity. So it's how we report it on the tax side that's going to be different. Now, the qualified opportunity zones, you're going to put the money into it. You're going to operate it. The real benefit is when you sell it after you've seasoned it in an opportunity zone after 10 years. And I don't know if there's a specific annual deadline, but after that time, when you sell it, then you don't pay tax on the capital gains. So the bookkeeping should not change. Basically, how you file everything should not change for the most part. There's a small little caveat there, but when you sell it, that's where the biggest change is going to be on the tax side.
No, that's great. And I think I love the audience participation today. With some really good questions on where I think everyone's mindset and kind of thinking, like a lot of these strategies, you just got to dig in and talk with your CPA and understand, hey, how am I becoming the best CEO of my last name? How am I running my investment portfolio? How am I putting these things together? Mike, I got a few questions and then we'll wrap up. And if anyone has any other questions, but I would say, for what's the one thing investors should stop doing right now?
Ooh, that's such a good question. Okay, I'll keep it on the same track because I'm very opinionated with that, but I'll keep it on the same track. Stop doing your own bookkeeping. I'll just say it right now because I guarantee you guys you're not doing it right. I've looked at thousands of different records of financials from people across many different, from just starting out to people who are doing over 50 million in annual revenue. And guys, you're not doing it right. I guarantee you aren't. Just so stop doing your own bookkeeping.
I love it. I love it. What's one report every investor should review monthly? I think I know this, so I'm gonna see where you're at.
Yeah. So check it out, guys. There's 3 reports, but there's one that you need to review. You have the profit and loss, aka income statement. You have the balance sheet. It's also important, but you have something else that most bookkeepers don't provide: the statement of cash flows, or the cash flow statement. All right, that's the one you need to look at. So the income statement shows how much you've made and how much you spent. That's what the income statement shows. The balance sheet shows how much you own versus how much you owe. But the cash flow statement combines them both. And I'll give you one quick example. When you pay a mortgage payment, it's mixed with some principal payment and interest payment. Okay? That interest expense of that total payment, that's the only thing that's on the profit and loss statement. That's the only thing. The principal payment gets deducted on the balance sheet, right? So now we're thinking, well, how the hell do I see all of the money that's coming in and out of the business? And it's this cash flow statement. That's the one that you guys need. So as you guys, we're not doing your own bookkeeping anymore. You go get a professional bookkeeper. The second thing is make sure that bookkeeper knows your industry, not a e-commerce bookkeeper, but a real estate bookkeeper. And the third thing is ask them if they'll give you a cash flow statement. Those are the 3 things I would say.
Boom. No, I love it. So much value added. Man, this has been great. I picked on a couple of tips, when I had my conversation with my CPA, like, hey, let's kind of dive into this as we kind of pivot in 26. And that's one of the things too with I started implementing profit first in my advisor business. It's kind of starting it up. And that's one of the things that I'm excited about doing, and kind of starting things the right way with that. So that's been a journey over the last couple of months that I've been enjoying doing. And I know you were generous enough to give us the reps time tracker. Yep. What's any other free things or anything that you would recommend to give out to the audience that can help them kind of as they're setting themselves up, that you may have a link to or anything?
Yeah. So what I'll do is, the other thing I'll give you guys is the home office reimbursement tracker that we have. Okay. Now I don't have it linked to my website like this. So give me a couple days, guys, but I'll do though. And then Johnny, I'll give it to you and then you can just add it back to the community.
Yeah, most definitely. I'll share it in the community.
That way I'm not sharing, I try to protect the actual Google Drive link. I want to give you guys something you can download and use, right? Without risking it getting manipulated or whatever. So, but yeah, I'll get that over to you guys. And again, if you guys just take your time and fill that out, you'll start to see how much more than above that 1,500 that we talked about that you'll be able to reduce off your taxable income.
No, that's awesome. We did get one last question, and thank you for that, Mike. I think that's definitely going to be value add. So I think this is a software question. What are your thoughts about Wave versus QuickBooks?
So I love these questions, guys. There are a ton of bookkeeping softwares out there, a ton, and they're coming out with new ones all the time. So this is my opinion. All right. And then you take it for what it's worth. My recommendation is go with QuickBooks. The reason why is because it is universally known. The amount of training that's available for free, by Intuit, who owns QuickBooks and QuickBooks, the amount of bookkeepers, accountants that are trained on the QuickBooks platform is massive. And the reason that's important is because as you're bouncing around, because you might have to interview a couple of different bookkeepers, you might not be with the same accountant that you were in the beginning. As you grow and as you scale, you want it to be as transferable as possible, because there's so much time and money wasted on trying to move from like Zero to Wave or Wave to QuickBooks, because the systems still don't work. They're proprietary systems. So whoever's transferring it has to take all the information out, put it in, recategorize it, and they're going to charge you for that time. So my opinion is go with QuickBooks. It's the most universal. You will always find somebody who understands it.
Yeah, no, I think when you look at QuickBooks and just the benefit of that I kind of started with some of the free versions, and you grow into it, but when you just being in it, the game, and I think the ease, ability, and really any accountant can talk QuickBooks that you go to. I think that's a no brainer. Yeah, any parting words? Kind of get off the stage. It's been great. I really enjoyed it, and I think this has really been value add for everyone that's kind of dialed in and supporting. That the taxes is. I was talking to my dad the other day, and we were talking about dollar figures and everything. And then I told her, I was like, you know what? It's not about what you make. It's about what you keep.
Absolutely.
I was like, at the end of the day, the taxes that we pay from, state tax, federal tax, sales tax on food. Virginia, we have personal property tax. We have property taxes. And there's a few other taxes that I'm probably forgetting as well, too. When you start talking about capital gains, estate tax, that this tax is everywhere. So having a strategy and understanding how you can stop paying some of those taxes and you can reinvest that money, that alone will set you up for long-term financial success. So this has been a phenomenal conversation, Mike. I really appreciate it. And just give you the last word to just kind of lead the audience with this morning.
Yeah, well, I appreciate the opportunity to come and chat with you guys. I love this group. I love where it's at. I love the participation as well. Here's the thing. We're all on the right path. We're all at different speeds. So when it's time for you to ask these questions, you guys have a team now. Please feel free to reach out to me. You can reach out to Johnny. Johnny's got my number, whatever we need to do. But I think everybody's you're doing the right thing by being in this group and taking action. Now it's just a matter of aligning our goals with our strategy. That's it.
That's it. That's where execution happens. Education without execution is entertainment. Exactly. And I'm not that funny. So, let's go. Well, it's been a pleasure, brother. Great for having you on. Definitely, if you're looking in the market for a new CPA, accounting firm, or need someone to just really run by your scenario, definitely reach out to Mike and the G2 team, and I know they'll take care of you. For those online, it's been great this morning. Next week, I know it would be Christmas Eve. We're still going to do kind of maybe a networking hour. I'm going to kind of bring some things with you and share a little bit about my goals and vision for 26, break that down a little bit more, and it'd be time well spent, especially as we kind of decompress, spend some time with loved ones, family, and reflect on where we've come in 2025. For me, this year is going by super fast, and really excited about 26 and everything that's coming. So online, we'll see you guys next week. Have a blessed rest of the week. And for those in the community here, we're going to chop it up in the studio a little bit. And let's go. Let's make some equity happen together.